You spent 12 years in school, possibly 4 more in college. You learned algebra. You learned the water cycle. You learned the dates of wars fought before your grandparents were born. And at no point in any of those classrooms did anyone sit you down and explain how money actually works. Not once. No one taught you what compound interest does over 40 years. No one explained the difference between an asset and a liability. No one told you that the tax code is written almost entirely in favor of people who own businesses and real estate, and against people who earn a salary. Today that changes. 21 facts, the ones they skipped, the ones that will change the way you see every financial decision you make from this moment forward. Fact 1. $1 saved in your 20s is worth $10 in retirement. At a 7% annual return, the historical average of the S&P 500, $1,000 invested at age 25, becomes $38,000 by age 65. The same $1,000 invested at 45 becomes only $3,800. Marcus invested $200 a month starting at 22. His friend David started the same contribution at 32. At 65, Marcus has $940,000. David has $420,000. Same contribution, same return, 10 years of difference. The difference is not the amount, it is the time. School never explained this. Most people find out too late. Fact 2. Inflation is a tax you never voted for. Every year, on average, your cash loses 3 to 4% of its purchasing power. $1 in 1990 buys what 41 cents buys today. Keeping money in a savings account paying 1% while inflation runs at 4% means you are losing 3% per year, guaranteed. Doing nothing with your money is not safe. It is a slow, guaranteed loss. Fact 3. The wealthy do not work for money. Money works for them. The average CEO of a Fortune 500 company earns more in passive income, dividends, equity appreciation, royalties, than they receive in salary. Their money is always deployed, always working. The shift from earning to deploying, that is the single biggest mental transition in wealth building. Not the strategy, not the vehicle. The shift in how you see money's job. Fact 4. Your biggest expense is not rent or food, it is tax. The average American worker pays between 25 and 40% of their income in combined taxes. Federal, state, FICA, sales, property. Across a 40-year career, that is hundreds of thousands of dollars. The wealthy spend tens of thousands on accountants and tax strategy because the return on that investment is measured in millions. $1 saved on tax is worth more than $1 earned, because the dollar earned gets taxed again. Fact 5. A credit score is not a wealth score. The financial system teaches you to care deeply about your credit score. But a credit score measures how reliably you repay debt, not how much wealth you have built. Some of the wealthiest people in the world have no personal credit score. They do not borrow personally. They borrow through entities. You can have an 800 credit score and 0 assets. You can have a low credit score and significant wealth. Understanding the difference is foundational. Fact 6. The stock market has never lost money over any 20-year period in American history. Not after the Great Depression, not after the 2008 crash, not after any correction, ever. Over every rolling 20-year window since 1900, the market has been positive. Short-term, volatile. Long-term, the most reliable wealth-building machine ever created. The people who panic and sell during corrections turn paper losses into real ones. The people who hold capture every recovery. Fact 7. You can legally pay 0% on capital gains. If your taxable income falls below approximately $45,000 for a single filer, your long-term capital gains tax rate is 0%. 0. Legally. This is a strategy used by early retirees and wealth builders constantly. They keep their reportable income below the threshold while living off appreciated assets. Most people have never heard of it. Their accountant never told them. Fact 8. The tax code contains over 10 million words. The Bible contains approximately 780,000. The vast majority of the deductions, credits, and structures in that code were written at the request of industries, corporations, and wealthy individuals who could afford lobbyists. The wealthy do not fight the system, they use it. Every deduction you do not take is money you chose to give away. Fact 9. Homeownership is not always the best investment. This one is controversial, but the math supports it. A house purchased for $300,000 in a flat market After mortgage interest, property tax, maintenance, insurance, and opportunity cost, often returns less than an equivalent investment in the S&P 500. Homeownership has emotional and lifestyle value, enormous value. But treating it as an automatic wealth strategy ignores the real numbers. Fact 10. The average millionaire has 7 income streams, not 1. Employment income, business income, dividend income, rental income, royalties, capital gains, interest. The reason is not greed. The reason is that any single stream of income can be eliminated overnight. A layoff, a market shift, a health event, a platform change. 7 streams means one can fail and the others carry on. Fact 11. Most financial advisors are not legally required to act in your best interest. Most operate under a suitability standard, meaning they must recommend products suitable for you, not necessarily the best ones for you. Only fiduciaries are legally required to put your interests first. Before you take financial advice from anyone, ask them directly, are you a fiduciary? If they hesitate, you have your answer. Fact 12. Dynasty is engineered, not accidental. The Rockefeller family has been wealthy for over 100 years, not because each generation gets lucky, because each generation inherits a system, legal structures, investment frameworks, financial education, and family governance designed to outlast any individual member. Wealth without a system disappears. Studies consistently show that 90% of inherited wealth is gone within 3 generations of the original builder. The structure is the strategy. Fact 13. Most wealthy people built their fortunes through concentration, not diversification. Warren Buffett made his fortune concentrated in a handful of companies. Elon Musk put everything into Tesla and SpaceX when both were nearly bankrupt. Jeff Bezos bet everything on Amazon. Diversification protects wealth once you have it. Concentration builds it in the first place. These are different strategies for different phases of wealth building. Most people apply the wrong one at the wrong time. Fact 14. Real estate is the most tax-advantaged investment vehicle in the United States. Depreciation, 1031 exchanges, mortgage interest deductions, cost segregation. A real estate investor can generate significant cash flow and legally show a paper loss on their tax return simultaneously. Lisa earns $4,000 a month in rental income. After depreciation on her property, she shows a paper loss of $6,000. Her tax bill on the rental, $0. This is not a loophole. It is the designed intent of the code. The government incentivizes real estate ownership because it creates housing, jobs, and local tax revenue. Fact 15. Your network determines your income ceiling. Studies consistently show that income is the average of your 5 closest relationships. Not because of magic, because of access, because of standards, because of what you believe is possible when you watch others do it. The people around you determine the opportunities you hear about, the risks you are willing to take, and the ceiling you believe is reasonable. Upgrading your network is not networking, it is infrastructure. Fact 16. Most people spend more time planning a vacation than planning their financial future. The average American spends 4 hours planning a vacation, less than 1 hour per year reviewing their financial plan, if they have one at all. The gap between where you are and where you could be is almost always a planning gap, not an earning gap. Fact 17. Debt is not the enemy. Unproductive debt is. Every major empire in business history was built using borrowed money. Real estate investors use debt to control assets worth 10 times what they could afford to buy outright. The question is simple. Does the debt generate more income than it costs? If yes, it is leverage. If no, it is a trap. Fact 18. The wealthy do not retire, they redirect. Buffett is in his 90s and still at Berkshire. Bezos left Amazon to run Blue Origin. Gates left Microsoft to run a foundation with a larger budget than most governments. Retirement, as it is sold to the middle class, is a relatively modern concept built around the idea of stopping. The wealthy redirect their energy toward what matters to them. That is a very different goal. Fact 19. Early compounding cannot be recovered later. A 20-year-old who invests $200 a month and stops at 30 has more at 65 than a 30-year-old who invests $200 every month for 35 years straight. 10 years of early compounding beats 35 years of late compounding. Let that land. Every year you wait to invest is a year of compounding you will never recover. Not partially recover. Never. Fact 20. You are one decision away from a completely different financial life. Not 1 year, not one strategy, One decision: to automate 10% of every paycheck into an index fund, to start that business, to hire the accountant, to read the book, to make the call. The gap between where you are and where the wealthy are is not as wide as the financial industry needs you to believe. Fact 21. The greatest wealth transfer in human history is happening right now. An estimated $84 trillion will transfer from the baby boomer generation to their heirs over the next 20 years. This is the largest intergenerational transfer of wealth ever recorded. The families with structures, trusts, legal frameworks, financial education will capture the majority of it. The families without those structures will lose most of it to taxes, poor decisions, and fragmentation within 3 generations of the original builder. The time to build the structure is not when the transfer happens. It is now. 21 facts, all skipped, all available to you starting today. None of these were in your textbook. All of them are in your hands right now. What you do with them is the only thing that matters. Before you go, something is waiting for you. At sovereignwealthtv.com, there is a gift, not for everyone, for the people who are serious, who show up, who stay to the end. Go to sovereignwealthtv.com. Present your seal word when you get there. What you find is our way of saying, we see you. Drop a comment below right now. Which of the 21 facts hit you hardest? The one you wish someone had told you 10 years ago? I want to know. I read every comment. Share this with one person who needs it. Hit subscribe. This channel is for the ones who are building. This is Sovereign Wealth. Stay sharp. Stay sovereign.